Algorithmic forex trading. Most retail bots look brilliant in backtests, then destroy live accounts. Here's why.
Algorithmic forex trading is software-driven execution. The decision to buy or sell is made by code, not by you clicking a button at 3 a.m. on a Tuesday. And the spectrum is enormous. On one end, a Tier 1 bank's VWAP algo breaking a multi-hundred million pound GBP USD parent order into thousands of child orders, so the market never sees the size. On the other end, an expert advisor on MetaTrader 5 buying Euro USD when the 50 EMA crosses the 200 EMA on the 1-hour chart. Same label, wildly different worlds. The institutional layer is about execution quality. TWAP, VWAP, implementation shortfall, liquidity-seeking algos that probe dark pools for hidden depth. They don't try to predict direction. They handle how to fill a giant order without revealing the size. The retail layer is the opposite. The algo is the strategy. It decides direction, timing, and size. That distinction matters because 9 out of 10 retail algos that look profitable on a backtest get destroyed in live trading. And the reason, almost always, comes down to the same two failures. Hold that thought, because by the end of this video, you'll also know why a backtest Sharpe ratio of 3 is a red flag, and a live Sharpe of 1.5 is excellent. Here's the first killer. Costs. Most retail traders backtest a strategy using the marketing spread, from 0.0 pips and 0 slippage. They get a beautiful equity curve. They deploy live. The curve dies. Why? Because the real cost per trade has 4 buckets, not 1. Spread, but not the floor. The realistic median for the session you actually trade. London-New York overlap is tight. Tokyo afternoon, much wider. Commission. Every raw spread account at IC Markets, Pepperstone, or Tickmill charges a round turn commission. Add it to every single trade. Slippage. Fractions of a pip on normal orders, multiple pips during news events. Most backtesters omit this entirely. And swap. Overnight financing on positions you hold past the broker's rollover time. Now do the math. If your strategy targets only a few pips per trade, a single round-trip cost can eat 1/3 of your gross profit. A positive backtest becomes a negative live curve. Not because the idea is bad, because the math was lying. This is why the broker choice isn't decoration. The cheaper the realistic round-trip cost, the more of the gross edge survives into your account. Choose the cheapest raw spread ECN broker your strategy is comfortable on, then rerun the backtest with those exact costs plugged in. Most strategies die at this step. That's the test working. So what actually works? Most documented retail edges cluster around a handful of structural ideas. Trend following on daily and 4-hour charts. Buy strength, sell weakness, size positions for drawdowns. Modest Sharpe, robust across regimes. Mean reversion on the majors during the Asian session, when liquidity is thin and post-New York drift often reverts inside the Asian range. News pause. Simply avoiding the 30-second window around scheduled releases is itself an edge. Some algos fade the initial spike. Carry trade overlays with risk-on, risk-off filters. Long high-yield currencies, short funding currencies, exit when the volatility regime shifts. Volatility breakouts at session opens with conservative stops. These aren't sexy. They don't promise 200% a year, and that's the point. The strategies that fail most often are scalping bots advertising huge monthly returns and martingale grids that look flawless until the first sustained trend wipes the account. If a marketplace EA shows 200% annual returns with a tiny drawdown, the realistic interpretation isn't enduring edge, it's parameters tuned to past data. The economics of EA marketplaces guarantee this. The genuinely good algos rarely get sold. Their authors trade them privately. What gets listed is mostly the curve fit residue. Now infrastructure, the part everyone skips. A serious retail algo doesn't run on your laptop, it runs on a VPS, a virtual server hosted physically close to the broker's matching engine. London's LD4 data center, New York's NY4, Frankfurt. Why physical proximity? Because your home internet drops during the exact news event your strategy was built to catch, and a VPS in the same building as the broker doesn't. Platform matters too. MetaTrader requires Windows Server. Python or C# API setups can run on Linux. You need monitoring. Telegram or email alerts on every trade open and close. Error notifications. A daily P&L summary. A watchdog process that restarts the EA if it crashes. You need a backup VPS in a different region for failover, and you keep the source code in Git with versioned releases that match what's actually running live. None of this is glamorous. It is the part most retail bots fail on. Strategy might be sound. The plumbing is what disconnects during the exact move it was built to catch. Beautiful logic, broken pipes, missed trade, dead month. Then come the tests. 5 statistical tools separate a strategy worth deploying from one worth abandoning. Walk forward analysis. Optimize on a rolling in-sample window, then test on the next out-of-sample window. The strategy must be profitable on the combined out-of-sample stream, not the whole history, the unseen chunks. Monte Carlo permutation. Randomize the order of your trades and look at the distribution of possible equity curves. Your actual curve should sit in the better half of that distribution, not at the lucky edge. Parameter sensitivity heat map. Plot performance across a grid of parameter combinations. A robust strategy shows a wide plateau of acceptable results. An overfit one shows a single narrow peak. That peak is the formal signature of curve fitting. Multi-market testing. A genuine edge generalizes to similar markets. A strategy that works only on Euro-US dollar between two specific dates is almost certainly overfit. And synthetic data. Generate price paths with similar volatility and fat tail characteristics, and test on those. A strategy that survives all 5 is rare. One that survives most of them deserves cautious, real money deployment with small size. Anything less is hoping the past politely repeats. Which brings us back to that Sharpe ratio. Remember, backtest Sharpe of 3, red flag. Live Sharpe of 1.5, excellent. Why the gap? Because retail backtests with Sharpe above 3 are almost always artifacts of overfitting, look-ahead bias, or unrealistic execution costs. The market doesn't offer those numbers. The same logic kills 3 other myths. Faster execution isn't always better. Beyond a basic latency floor, microseconds only matter for ultra-short arbitrage plays that are beyond retail reach anyway. More indicators don't reduce risk. They add parameters that overfit. And AI doesn't grant automatic edge. Machine learning helps when you bring alternative data, news sentiment, central bank language analysis, options implied volatility, order book microstructure. It doesn't help when you throw a transformer model at standard OHLC price data, hoping it finds something humans missed. The track record there is poor. So here's the verdict. Treat algo trading as a 6-month project. Month 1, learn the platform, MQL5, cTrader's C#, or Python on the OANDA API. Month 2, code one specific idea with 2 entry conditions and 1 exit rule. Month 3, backtest properly with realistic costs and walk forward. Months 4 and 5, forward test on demo, then on micro lot live for at least 60 trading days. Month 6, scale only if live performance matches forward test within a sensible tolerance. Use an ECN broker that explicitly permits EAs, IC markets, Pepperstone, FP markets, Tickmill, Fusion markets, OANDA, or interactive brokers all fit. Model the 4 costs honestly. Run the 5 tests. Aim for a sustainable Sharpe, not a fantasy one. That's the difference between a working algo and an expensive education.
6 months, 1 idea, honest costs, 5 tests. Full breakdown and broker links in the description.